The Invesco Nasdaq Qqq ETF has been a very popular title to be traded, and in today's video, we're going to look at the price actions, the recent developments, the technicals, and my opinion on if you should buy the stock. As the market is still very volatile for the moment, we should be mindful of which positions to pick, as well as their individual timing and exposure. Before the video begins, if you would like to see more stock analysis videos like this one, please remember to like, comment, and subscribe to my channel. The Invesco ETF tracing the Nasdaq performance has been seeing a significant amount of volatilities over the past 24 months, going from the valuation literally halving overnight back in March 2020 to skyrocketing from 2020 and 2021 before the big tumble in 2022, which basically continued to this day. It has always made me wonder what really justifies the takeoff of those valuations while the world economy went from a state of increasingly wobbly and fragile growth to almost certain recession once the effect of massive government subsidies goes away. I mean, I can understand that for some of those companies, like Tesla, the valuation increased because the company itself became profitable during that period of time. But even then, it's kind of pushing the logic, right? Another reason is that for many of those stocks, because people say that they have real growth potentials in the future and decided to cash out most of that potential in the short term, shareholders don't want to assume the cost of a well-established company for what is de facto still a startup. Another factor to consider is that investing in growth stocks or tech companies is something that does require a bit of risk appetite from investors compared to the safer and more predictable options, such as fixed income and blue chips. Now, this is why I think that overall, Nasdaq is expected to correct its overall value back to somewhere people are comfortable about how things are valued before putting more money. With that being said, the macroeconomic factor is also dealing with the fact that the capital around the world is at the same time trying to find a safe haven, and the US stock market is still one of the best for that purpose. This is why, even if the QQQ is expecting to retrace, it's going to be a long and hard grind downward in the short and medium term. Now, let's take a look at the technicals of QQQ. The trading volume of Invesco Nasdaq Qqq has been around 60 million shares versus the average volume of 67 million shares. Over the previous 52-week period, the price fluctuated between $269.28 and $408.71. The trading volume is a metric that can tell you how many shares are being exchanging hands and whether there's a lot of activities and attention on the stock. It often gives you a first idea about the popularity of a company, and we can use it to compare with the average volume to tell us if the company is enjoying additional momentum to reverse the trend or to break through the current resistance. Even when the current volume is lower than the average, this could be an interesting indication because this may signify that a trend reversal could happen soon. The market cap of Invesco Nasdaq is currently around $161 billion versus an enterprise value that I would say is about the same, although we have to remember that these are tech companies, essentially, that we're talking about. And to be put simply, the market cap is the fair market value the company has based on the current market sentiment, the company's reputation, and other macroeconomic factors, whereas the enterprise value is usually based on the cost of the company's assets, whatever the cost that they've paid those things for, after paying off the debts. It's worth mentioning that one of the most significant assets for a lot of growth companies are the intangibles, and that's especially true for the QQQ, meaning they're not items or stocks that companies could use to generate income, but secondary items that could provide growth potentials for the future, such as pledges for major contracts, blueprints, intellectual properties, brands, and so on. So for startups, most of their valuations are based on those intangibles, which tend to be valued under more favorable market conditions, especially the ones that went public over the past 2 years. In concrete terms, this means that there could be a huge difference between the market cap and the enterprise value, giving a false impression to the market participants that a company is trading at a discount. It's only trading below the book value, but that doesn't mean that a company itself is necessarily undervalued. It's also possible that a company itself was overvalued in the first place, and that it has been deflating back to wherever it should be. As we compare the current price to the historical price fluctuations, the stock is 9.7% higher than the 1-month low, 9.7% higher than the 12-week low, and 9.7% higher than the 52-week low. On the options market, which gives you a hint of the market sentiment about where the stock price is likely going to head next, the implied volatility is 29% versus a historical volatility of 35%. The put-call volume ratio is currently 1.32. It's normal for most stocks to also tend to have a higher put option volume than what they deserve, and in this case, what this means is that most people are expecting the stock to keep go lower, right? That the Nasdaq is going to keep tanking. So the most recent volume of options traded has been 2.6 million contracts a day versus the 30-day average volume of 2.5 million. In terms of open interest, the most recent volume of open interest has been 7.8 million contracts versus the 30-day average of 10.6 million contracts. So the option contract is a derivative for the underlying security, giving participants the possibility to have the right to either buy or sell the security at a predetermined strike price. Buying the contract gives you the right, and selling the contract gives you the premium, with an obligation to execute if the counterparty chooses to do so. It is often said that you can evaluate the likelihood of a scenario based on the opposite of what the current ratio is. I mean, if there's a lot of put options that are being traded, meaning everybody expecting the stock to go down, the opposite may happen. And vice versa, if a lot of people are buying the call options and hoping that the stock may jump from where it is. And the reasoning behind that theory is very simple. Most people, when they buy option contracts, they buy them after the fact. They try to catch on the gravy train when the train is already gone. And as a result, most of those options tend to expire worthless. In terms of the shareholder structure, institutional shareholders own 45% of its outstanding shares. The biggest shareholders include Bank of America, Citadel Advisors, and Citigroup. It is relevant to understand the shareholder composition of a company, as this helps to determine if you should be holding the stock long-term or to view it as a trade opportunity. If the stock is mainly held by retails, this could be a sign that the stock may lack the depth to justify long-term trust from shareholders. Typically, the consensus is that there should be at least 25 to 30% of institutional participation for the stock to be perceived as a sound investment and not just a short-term trade. Obviously, there's a lot of exceptions that would apply, as many absolutely great companies are still held for the most part by retails, and they're worth the investment. But that tends to be the exception and not the rule. Let's also take a look at the short interest present in the stock, which is the amount of positions aiming to profit if the share price falls lower. Sometimes when there is significant short interest in the total volume, this may be a sign that there's an organized shorting operation happening, such as what happened with GameStop and AMC. The current short interest is 2.5% of the total float and 52% of it coming out of the dark pools. So in other words, not that many people are shorting the stock per se. Usually, if the short interest is above 15% of the total volume, this could suggest that there are institutional positions taken to short the stock, and that there would be potentials for a short squeeze. Now, my recommendation is to dollar cost average down the Nasdaq over the next 12 to even 24 months, and to hold it for the next few years. This is certainly going to be a long game, and in my opinion, the long term should favor Nasdaq once the current correction and the possible recession is behind us. I would recommend to commit between 5 to 8% of your portfolio in the Qqq, and would also recommend to split your allocation in batches of 20% at a time so that you can purchase more if it retraces. Now, given the current market environment, I believe that the equity market is in a vast phase of correction, especially when it comes to tech and growth type equities. The financial market has been living and breathing thanks to the continuous creation of new capital, with different waves of quantitative easings, which will have consequences on the price of assets as well as their yields. With the interest rates kept relatively low over the years and the increase of amount of capital in circulation, this will keep putting significant pressure on the profit that we can expect in investment products across the board. And this, by the way, is a reality that may shift in the years to come if the interest rate of core infrastructures within our globally financialized system increases. It's useful to remember that the market doesn't represent the real economy, and of course, the real economy doesn't always reflect in the stock performance, since the name of the game here is ultimately called supply and demand, which depends on a whole bunch of factors that go way beyond our own control. If we think about it, this is like saying, if your neighborhood house that is put up for sale is only allowing those who actually want to live inside to buy it, versus if you allow every single type of buyer with different intent or reasons to buy or to sell it. So obviously, there will be a significant difference in the price of this asset for those two scenarios. The market currently works more like the second option, and assuming that it would only reflect the fundamentals of the underlying economy would correspond to the first option. There are a few elements that are considered to be the reasons. The first one is the significant increase of amount of money printed by the central banks around the world, which is then distributed to the banks, with the expectation that they will be loaned to businesses. Normally that's a good thing, but with a lack of opportunities in the real economy, the significant portion of that money actually went back to the financial system to buy up the price of existing assets. Now that the QEs have been wrapping up, or ended around the world, I think that this drive behind asset price may no longer be as relevant as it is right now for the future. It is now compensated by the arrival of capital from one region to another, and from one sector to another even within the same jurisdiction. With the increase of tensions around the world, capital is always looking for a safe haven to park their money into, not just for a place to grow the nominal value, but with a currency that tends to keep its purchasing power as well. The third factor is the creation or the birth of artificial bubbles, either maintained by the market trends built up over the years or out of necessity. Capital needs to find a place to stay. Some good examples of this would include the EV sector in the 2020 and the oil and gas securities when there are tensions around the world. Either way, when it comes to the price trends of the market, degree of uncertainty is a key drive behind the price fluctuations, and that is likely going to increase as we go on from there. When companies announce that they are going to enter or exit different markets, or that they will be trading on different platforms and exchanges, this can all have significant ramifications on the price of this asset. Some of the considerations to have when operating in this context include having a clear view of what is going on, especially regarding the cash flow and the capital flow, and avoid certain potential pitfalls. One of these is to be careful with short positions. Inherently, short positions are riskier than long positions as the downside of long positions is limited, whereas the short positions can lose you as much money as the stock price may reach, which is infinite. On top of that, we're now seeing a new phenomenon with short squeezes, involving a group of retail traders propping the stock price up, forcing short sellers to recover their positions. Sometimes the attempt will not succeed, but sometimes they end up in very spectacular success. Something else to consider is to treat tech stocks with care. To start, ask questions when the price of a security skyrockets without real fundamentals. It doesn't mean that you shouldn't be touching it with a 10-foot pole, but it does mean that there should be a difference between the decision of long-term holding and short-term trading. Either way, a rule of thumb is that each position should be structured in a way so that their individual performances will never affect the portfolio's stability. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.